All right, good afternoon, everybody. Hope everybody's doing well. And I sent out we sent out an email quite late. Next week, it'll be a few days early. But, for those who didn't get a chance to see this, it'll be recorded and we'll send out the link. But what I was thinking about today was this concept of low maintenance range bound trades. And before I get going, I want to see, what does that mean to you? What does it mean to you if I asked you, what would low maintenance to you mean? Not a lot of work, or what would that mean to you? You could just type in the chat. What would that mean? Anybody? What would be an easy for range bound? What would be low maintenance for you? What would be something that you would be comfortable with? Troy, help me. Set it and forget it, right? That's kind of easy, right? Set it and forget it, all right? Then it says free adjustments, right? A few adjustments. Okay, I thought I said free adjustments. For few adjustments. What else? What else would be?
You have a top?
What else would be? Let me. Yeah, if you guys could, when you come in, you could mute your. Let me just get that here. Mute your. Let me see. I think I got it there. Okay. If you could, yeah, mute as you're coming in, but not a lot of adjustments. And so what I'm going to talk about today, I had two ideas, but now my two ideas, as I had a few more minutes here, turn to five. Maybe I'll get it to four, but I want to give you an idea. And really, if you said to me, what would be the goal here? The goal is that, as I'm just showing you maybe three or four ideas, and these would be all relevant to what's going on in the market now. We're in a still relatively tame VIX environment. We're 14. And 14, even though we've gone down 120 points over the last week or something, we've basically been going up, right? We've been up 300 points over the last month. So for perspective, is this more than a pimple on an elephant's behind? The amount that we've been down, the highs were 53.41 in the SPX about 8 days ago. And so we're down 125 points. How many think that's a lot?
This is
On a $5,200 vehicle. How many think that's a lot? Yes or no? I'll give you the answer.
What is it doing?
No. Yeah, it's not. Let me just, I won't keep doing this, but you could, when you come in, for whatever reason, the Zoom has your mic on. So if you could turn that off when you come in, that would be a help. So let's jump in here. So if you look at the SPX, what do we see? Today we had the PCE, and market was up 20 and down a little bit. We've got a high of 52.56 for the day, low of 51.91. First losing week in 6. Again, the last month we've been 5,000 to 53.41. So we're still only 125 points off the high. Now, the 50-day moving average was around 51.79. And I think we got the 51, what was the low today that I said? 51.91. So it just looks like it kind of held there for now. Now, so let's jump into some ideas that I think would be reasonably low maintenance. And how I would define low maintenance is this: something that you could say set it and forget it. And I think, what trades come to your mind when you think set it and forget it? And you can do that with any strategy, believe it or not, but more than not, what strategies come to your mind with set it and forget it? Set it and forget it, to me, 0-day strategies. How many do 0-day strategies on a semi-regular basis? Semi-regular basis. Maybe a 0-day credit spread, or a 0-day iron condor, or a 0-day butterfly. Anybody? Anybody? Those have worked remarkably well over the last couple of weeks. You might say, why? Why, Dan? Why have they worked so well? Well, if you look, most of the last 2 weeks, 3 weeks, other than days we know had that we're going to have more of a range in SPX between the high and the low, like the NVIDIA earnings. What was that, Wednesday or Thursday of this, Wednesday of this week or Thursday? And then today with the PCE coming out. Well, most of the days we've had ranges in SPX of like 30 points or 35. So if you put on a range bound trade, or most essential purpose, you know, depending exactly when you put it on, but it was wonderful. All right. Now, so let's jump into, I'll try to go relatively quick only because it's recorded and you can go back, but give you 4 ideas you can think about for, and what I'd like to do at the end is ask you and say, out of the 4 strategies that you saw today and how I talked about them and the, you know, some basic management of it, what do you think you'd feel more comfortable with? What do you think you would pick, or what do you think you would choose? So I'll give you 4 ideas. Deal? I'll give you 4 ideas, and then at the end, you can choose, hey, which one would you be comfortable doing? Which one do you think you could stick with for 10 weeks straight? And then my challenge to you, or my challenge would be, hey, go practice it on paper for a couple of weeks until you, and then maybe do 1 contract, but do it for 10 weeks, right? And that's where I find the hardest problem. The hardest thing is developing into a craftsman in option trading. You need to do these strategies over and over quite a few times. And that's really the challenge. So let's jump in. The first strategy I'll give you for today is, and really what, so range bound, a couple definitions, 3 definitions, so we're all on the same page. Range bound strategy just means, I'll give you 3 definitions and how I'm using them. Range bound, what does range bound mean to me? Range bound means strategies, I don't need the market to move to make money. Time decay or theta is in my favor. And range bound, I'm starting out with a position, you know, within a couple deltas, you know, 0 to 2 deltas, long or short, something I would consider relatively range bound. And that would be range bound. Low maintenance to me, my definition of it, would be something where one side, if the market goes up or down, at least in one direction, it's very low stress. I can handle 100, 120 points if the market moves either way and either have zero risk in one direction or, a little bit of a loss, right? So I only have to deal with one direction that the market could go that could hurt me, and I'll give you something to do in that direction. So basically the strategies I'm giving you have little or nothing, basically nothing to do on one side. The other side, I give you one thing to do. How many does that seem palatable? Dan's going to give us 4 ideas. Basically nothing to do in one direction. And in the other direction, a clear guideline what to do. You're supposed to say, yes, that sounds reasonable, right? Can I have another yes other than Simon? Nobody? Who would like to? Okay, I'm just checking for pulses at all times. All right, so the first strategy would be, well, I'll give you 2 of them because one comes from the other. How about something as simple as and again, you could do this from the call side or the put side. So strategy number 1 would be, here's a put credit spread. Here's the underlying right now. We're at 52.20 in the SPX. And again, low maintenance, we'll call it risk in one direction. What do you do if it goes against you? One thing. So if we're at 52.20, I'm selling, in this example, 50.70 put in the June 21 expiration. So this is about 3 weeks out. And I'm buying as a hedge against it the 50-50 puts. By doing this, I'm bringing in, let's see what this says here, about 250 credit. Who could tell me what's my margin on this trade? How much capital am I putting up? The difference between my short and my long in the credit spread is 20 points. So it's $2,000 of risk less a credit of 250. So it'd be 1750. So the most I can make is $250. My margin is 1750. It's a decent risk, or decent, what do you call it? Decent return, 14-15%, right? No risk on the upside, no risk if we sit here. The blue graph is the expiration. The purple is today. Now this is, I don't want to be more on any of these trades than 2 deltas long or short. So the question on this, I'd have nothing to do on if we go up. And if we go down, I think what I would do is doing this long term on a regular basis. And again, you could do this in calls or puts. I just chose puts here. Let's say we've been down 130 points. You've got to pick one direction. The good thing about a strategy like this is whether you pick calls or puts, you're getting about an 80-85% probability starting out.
Right.
Dan, how do you figure? Well, if I'm selling the 50-70 puts here, let's go to the downside. They have a delta of 15. What does that mean? You're picking your short strike of the credit spread by a 15 delta. What does that mean? It means there's only a 15% probability we'll finish under 50/70 in the SPX by June 14. So that means there's an 85% probability, right? We would get our credit, right? And obviously, what affects that probability is what you do on this. Now, how I would trade this, I'll just give you one idea here. And yeah, I think you have to trade it something like this if you're going to do kind of a no touch, forget it. So again, on the upside, I'd be looking to make 10%. 10% of your credit? No. 10% of your margin. So I'd be looking to make about $175. Okay. So if I sell it for $250 and I want to make $175, where would I buy it back? Where would I buy it back? Sell it for $250 credit. I'm going to make $175. That's 10% of this. I buy it back at, thank you, Mark, 75-cent debit. Sell it $250, buy it there. What if it goes against me? In this type of a trade where you want the probabilities to work in your favor, what I would do is I'd have a 20% maximum loss. So 20% of 1750 would be about $340, somewhere around there, 350, 340. So basically, if this credit goes from 250 up to 340, so if we get 340 or higher, get out, right? Dan, why are you giving it 10% profit, 20% max loss? Because a lot of times we go down, we come up, we go down, we come, you got to give it room to breathe. But again, the other idea is this, folks. Do you have probabilities in this trade? If Mark O'Hare or Rob said, I'm going to play when I think all the tea leaves line up. I'm going to play when I think Fibonacci says Gubernacci. I'm going to play blah, blah, blah. Do the probabilities work in your favor when you pick and choose when you play? Yes or no? Yes or no?
No.
No. Oh, you could just type it in. I appreciate that. You could mute and just, you could just type it in. Yeah. No. Now, when you're doing credit spreads, can you go with the trend and say, I'm going to do a put credit spread as long as we're over the 50-day moving average, I'll do it, or whatever, or some basic technical thing. I don't have a problem, but you want to play this on a regular basis, right? Now, so anyways, according to that, what I said, what I just described to you, would you call this low maintenance? Nothing to do on the upside. You're going to sell a 15 delta put, 20 wide, and if it goes against you, you'll only get out if it goes 20% loss. Is that easy? Now, do you remember the movie with Jack Nicholson? What was the name of it? Can you handle the truth? Tim says yes. Anybody else? How many think they could handle that, doing that type of thing every week, putting one of these on? How many think they could handle that? Now, again, if I was to do a put credit spread, I would have just some basic thing like, we want to be over the 50-day moving average. Or you don't have to, anybody but Tim. Anybody but Tim have an opinion. It would be easy to manage. It would not be easy. I need at least two more opinions. I want to make sure there's pulses going on. People are breathing. Everything's working well.
Every time I talk to you guys, fucking something going on.
Okay.
Doing shredding. I'm doing shredding.
1 second. And if you could make sure your audio is muted, just to let you know that it's on. Anyways, all right. But you know what the big problem with this is? here's the problem. The problem is Tim and whoever put me. I'm joking, but here's the problem. Could you stick with the program? Could you do this every week for 20 weeks? Right? We might say yes, but how many, if you lose on a trader, is it tough to come back from a losing trade? It is. So the tough thing with something like this is believe in the probabilities and play it. Agree? All right. Second trade that I'm going to look at, and I'll come around to this. I mean, there's other things you could do. How many have heard of a skip strike butterfly? How many have heard of one of these things? Kind of looks like a credit. And this is what I like about this is I'm only one delta long, right? It's similar to what I just did. What I just did is a vertical. So let me just, for the skip strike butterfly, let me explain. Here was the credit spread. I sold 150.70 put. I bought 150.50 put. How did I pick the short strike? It had a 15 delta, right? Remember, I went to June 21. Remember I did that? And I looked at a 15 delta. Remember I did that? And you can see oh, maybe the market's moved a little bit. All right, 18 delta on this one. Okay, that's fine. 18 delta, right? 15 to 18. Now, the skip strike butterfly is saying, really, skip strike just means I buy the 50-80 puts, sell the 50-70, I skip the 50-60 put, buy the 50-50. This would be a butterfly. Why do it? What's my thinking? It's basically saying, hey, I'm a put credit spread. I'm starting this put credit spread, and I'm 2 deltas long. What if I want to get it more range bound, get it within even a delta? What could I do? All I'm doing on top of this is reducing my deltas by, right? So I still have this foundation. I'm buying 150.80 put, selling 150.70 put. Okay, so I'm starting with a put credit spread, right? It's basically saying I'm starting with this put credit spread. But then I look at it and say, you know what, Dan? I'm about 2 deltas long. It's a symbol for deltas. What if I want to be closer to range bound, maybe 1 delta? What can I do? Overlay on top of that, sell one more 50-70 put, and buy one 50-80 put. Oh, wait a second. So what you're telling me is you're starting with a 20 wide put credit spread like the previous example. But on top of that, you're buying a put vertical debit spread. And that'll reduce the entire trade. Now I'll be 1 delta long. So I'm basically reducing the deltas of a credit spread by overlaying a vertical debit spread on top of it. And that's all this is, right? So if you look at this, it's very similar to a put credit spread. We put this on here at 52.18. I have no risk up here, right? So the easy low maintenance. Now I'm going to give you a different idea on maintenance on the upside here. But again, it's the same stinking principle, right? If we go up 1 billion, yeah, you could call it it's in the broken wing butterfly, I guess, skip strike butterfly. But there's no risk in one direction. But what I like about it, you say, what do you like about it? we do range bound strategies. Our most popular range bound strategies we do in the Sheridan community are calendars and butterflies. They both have risk in each direction. Wouldn't you love to have a trade with no risk in one direction if it was more range bound? This is it. What do you mean? The deltas are basically one or less on a $5,200 vehicle. That's kind of delta neutral to me. And I've eliminated one of my enemies. What's that? Zero upside risk. Zero. None. And I have some room on the downside. So I only have to deal with one problem? Correct. Only one problem. That's it. Now, I'll just give you, just so we get that, I just was using different ideas on this. So if we go up, no problem. If we go down, I can add a call credit spread on the upside for free. What do you mean for free? Right? What do you mean for free? Here's what I mean. If you look at the skip strike butterfly, our margin on this trade is $890. I'm bringing in a credit of around $110. If it goes against us, if it starts going down and I add a call credit spread against it,
Nessun beslefası su.
my margin actually goes down, right? My margin actually goes down, right? And that's what the vertical is. So again, we talked about a vertical, a skip strike butterfly, things you could look at. Let me move to the next one. How many have done a calendar trade here? How many have done a calendar trade in their lifetime? Yes or no? Dan, I've done a calendar trade in my lifetime. All right. So I'm going to give you one idea. Again, this low maintenance, try to eliminate risk the best we can on the downside. So how many people think, and whether you, I mean, you could do it either side, but how many people are more concerned at this point that they would, if you had a choice, how many people would say, Dan, I'd rather, if I'm going to set up a range bound trade, I'd rather set it up with more room on the downside, A, or upside, B. Hey, Dan, if I'm going to set up a range bound trade right now, I'd want more room on the A, the downside, B, the upside. What would you say? Yeah, so if you're setting up like that, the downside, this is called a diagonal calendar. What's the definition of a calendar? A calendar is a mixed month spread where I'm buying a further out expiration, selling a closer in. What's the definition of a diagonal? Different months, different strikes. Calendar, different months, same strike. Diagonal, different months, different strikes. So if you look here, we're at 52.16. So how I would set it up, I'm going to go out to June 14, out a couple weeks, sell one, June 14, 52.25 call. Got it? So I'm going to sell a strike about 10 points over where we're trading a couple weeks out. Then I'm going to buy my long 4 days further out and 5 points up. Why do you call it a diagonal calendar? It still looks like a calendar. Why do you call it a diagonal? Because it is a diagonal. What's a diagonal? Different strikes, different expirations. Okay. Now, today's Friday. We're almost done with Friday. So I'm going to run this on Monday's date, which would be the 3rd. But you could see here, So why am I setting it up with my short strike 10 points higher? Because I'm starting the trade just a little bit of short delta, right? So if we go up, I'd rather set my short strike above the market. Give me a little bit of a head start. But what I like about this, remember, this is the theme today is low maintenance. So here we are right now. If I put this on 52.15 and I have it on Monday's date, if Monday we drop 100 points, boom, should Rob and Simon go underneath their bed and start crying? Yes or no? We're down 100 points Monday, huge move in the SPX. Should they go underneath their bed crying? Will they be in big trouble? No, no, no. We go down in this area, I'm up money. So the diagonal calendar, the downside, I'm good, and I'm long Vega. What does that mean? Usually when SPX goes down, volatility goes up. So that should benefit this. So what could you do if it goes down 100 points? You could take some money out of it or close it for little or no loss. But is that a good accomplishment? Yes or no? If we go down 100 points in a day and you can break even or make a little bit, right? And then the next day put on something else. Well, I mean, if we went down, the volatility would go up. So I'd probably put a butterfly, but is that reasonable? Right, easy queasy, all right? And then on the upside, what do? One thing, right? What I would do is, if we go up to say, let's just say we go up, you can see, if we go up, I would say, I'd look at the expiration break even where you see these red vertical lines. And I would go maybe, let's say 20 points before there, maybe something like that. Especially early in the trade, but let's say we go up to this 52.80 area, 52.90 area, let's say 52.90 even, and I'd add a calendar like 40 points up, right? So we go up to this 52.90 area before the break even a bit, 10 or 20 points before, right? We get up to this point, and you could put an alert, right? If you're out in the garden, put an alert, 52.90, whatever, 52.80, 52.90, go at a calendar 40 points above that point. So we're just enlarging the tent. That's it, right? Nothing downside, except if we're down 100 points or so, close it, go have a sandwich. The next day, I'd probably rather do something else, right? But no problem. If we go up 10 to 20 points before the break even, put a calendar on. And I think in this case, let me just be a little more clear. Again, I would go about 20 points before the break even, take that point, add 40 points, and add a calendar the same distance 4 wide, same expiration. So just enlarge the tent. How many think they could do that? Yes or no? How many think that's rocket science? Yes or no? Now, what's the good part of this? The good part, if Simon or Rob actually did this, picked one of these strategies I'm talking about today and did it 10, 15 times, do you think they'd start making it their own? Do you think they would get better? Do you think if Simon and Rob made fettuccine Alfredo 18 times in a row, should they get better? They should, right? If they use the good ingredients. Let me ask you, coming from my wife's born to a Sicilian family. I grew up Irish, and I'm still Irish. And I grew up Irish, but now I'm Irish 100%. She's 100% Sicilian. And an Irish family, not that food we all eat wasn't as important. And an Italian family, food is a major thing, right? It's a big deal. Here's a quiz question. In an Italian, you know how I can tell someone who's serious Italian cooking and takes it serious? What ingredient is the most important ingredient in Italian cooking? What would you say? There's no one right answer, but this is one that comes to my mind. What would you say? Come on. Garlic, you're right. Garlic, yeah, and garlic might be the best. Tomatoes. Homegrown. How about olive oil? How about olive oil? Now, here's the quiz. If you're a serious Italian and serious cook, when you go into a restaurant, do they have 100% pure olive oil? Yes or no? In most restaurants, they use a blend of what? Canola oil and that. But the true Italian, hey, are using 100% olive oil. That's a stickler. Am I right? Any Italians out there? You need the 100% pure olive oil. Anyways, so let's move on. So any questions on that trade? Any questions on the diagonal calendar low maintenance? Any questions on that? All right, low maintenance strategy number 3. I'm giving you this would be a 3-week low maintenance butterfly. I start looking at these when we get near 15 volatility, but I made one work today that isn't bad, just to show you. I call it a Sherman tank. Now for a short term, I'm tweaking it a little bit because I don't usually do this strategy unless VIX is closer to 16, but I made it work for today for the low maintenance. So here's the strategy. We're at 52.18. And I want to set my short strike about 5 to 7 points over where we're trading in. You with me? So I'm going June 21. I'm 3 weeks out. Set my short strike. I'm going to set it at 52.25. 7 points over where we're at. I want to go down 60 points, right? Down 60 points. 51.65. Up 55 points. Let me run through the logistics again. June 21, 3 weeks out. I'm selling about 5 to 7 points over where we're trading at, 52.25. Go down 70, down 60, up 55. This is only on a 21-day butterfly. If I'm going further out, I'd go maybe 70 wide or something. This is a 21-day. Now, Dan, how does this get in the world of low maintenance? First of all, I'm short 1 delta. So that gets me into definitely in my area of range bound trading, right? 1 delta long, 1 delta short on a $5,000 vehicle. That's good enough, right? Now, so if I look and I say, what if we open, right? What if we open Monday down 100, right? First of all, the cost of this trade is about $1,200, right? $1,200. Monday, we open down 100, 51.20. So where are we at? 52.20. We get down to this area. Well, this says $111. And that's 100 at a crack. It would be, here we are, let's see, again, if this is totally correct, let's say closer to 51.30 would be 90 points, right? You'd be down $50 on 1,200. Generally, this type of a trade, 60-55, be a broken wing butterfly. What does that mean, 60-55? The bigger number, 60, would be your downside width. So if my short is 52.25, I said I would start it at 5 to 7 points up from the current price. I'd go down 60, right? Up from the short strike 55, right? Now, for a 21-day butterfly. Now, generally this type of butterfly, it's just saying I can handle quite a bit of heat on the downside. I'll usually put it, I'll either make my money on this as we're going down, or maybe if we get down around 90 points, which would be a lot for one day, generally I can take it off for little or no loss, and then the next day regroup. But again, the idea on today's presentation is low maintenance. Dan, let me eliminate risk in one direction, right? And again, you could do something to the upside and eliminate. You can do this to similar. I would tweak it a little bit if I didn't want any risk on the upside. Now, and then on the upside, what could you do? Right? So on the downside, what I would basically do is say, look, I got a range-bound trade on. Let me ask you a question. If you're doing a range-bound trade and we move 100 points, Simon says, what dictates how far out you go every time? I mean, generally, calendars and diagonals is a general guideline. Simon, I like a couple weeks out. Butterflies, 3 to 4 weeks out. And I generally would do it. But yeah, that's kind of what I would do. But the idea is what I'm creating here. I mean, there's a lot more to it than that. I'm trying to give you 4 things in about an hour that to get you started on. Obviously, becoming a craftsman, you got to do it a little more. There's more, but I'm giving you the basic gist of it. The bottom line is if it goes down, unless you're more experienced than you, but even if you're not, if we go down 90 points on Monday,
Fucking believe it.
if we go down Monday, if we go down if we go down 190 points on Monday, does that have anything to do with range bound? Yes or no? If we go down 90 points on Monday, is that anything to do with range bound? And generally, profit target would be 10%, some type of max loss of 50. No, so if we go down 95 points or 90 on Monday, and you can get out of this at break even or down a tinge, would you be happy? Yes or no? Would you be happy? Yeah, and then you could just regroup the next day. On the upside, and I will just give you an idea. One thing you could do, if we go up, and there's a million things you can do. I'm just trying to give you something, right? On the upside, if we get up near the expiration break even, and in this type of trade, I'm starting out just a little bit short delta. So I would come maybe 15 points before the expiration break even. So if the expiration break even here is 52.75, I'd come in at maybe 52.60, 15 points before. And at 52.60, what would I do to this butterfly? This is a June 21 butterfly, and I'll just write it for time so we can get going here. But if we get to 5260, I would add a butterfly 30 or 40 points up. So let's say 40 points up. We go to 5260. I'd add a butterfly of
你今天
5300.
有没有换衣服啊？
嗯，
所以你今天晚上也要继续要会，所以那你明天可能就要加油。
All right. I'm just, unfortunately, people aren't always aware of if that their phone is, or they're not muted, so I want to make sure I help in that area. All right. So what I would do is we go to 5260. This is a June 21 expiration. I would sell one June 21 5300 call. So again, we get up about 15 points before the break even on this little bit short delta butterfly. So if we go up to 5260, I'd sell one 5300 call in the June 21 expiration. And then I'd go maybe 4 days further out, June 21, or excuse me, buy a June 25 5300. So again, this is the third of the low maintenance strategies. No problem on the downside. Just, hey, we have a big move, get out, wipe your brow, jump back in the next day. On the upside, we get maybe 15 points before the break even. Add a calendar. All right, last one for today. You ready? Last one, and then we're going to do a vote. Last one, and this would be maybe a little more fun. So let's look at next week, the expected move for next week. Say, how do you know? I don't know. The market tells me, right? June 7 is a week from today. The expected move is about 70 points. What does that mean in English, Spanish, and Swahili? It means if we're at 5220, let's say we close around 5220 today, and the expected move is 70 points. That means there's about a 1 standard deviation, 68% probability that at the close of trading next Friday, if we close at 5220 today, we'll be between 5290 and 5150. 1 standard deviation. So 1 standard deviation is saying there's a 68% probability will be between here and here. Now, 70 points. Now, so I'm taking that information. You ready? I'm taking that information for our last low maintenance. So far, low maintenance for those staying with us. We had a vertical credit spread. Remember that first low maintenance. The second one was a skip strike butterfly. The third one was a broken wing 60-55 fly. I call it the Sherman tank. And number 4, which will be right now, I'll call it a combo fly. And all of these, I mean, I'm just giving you some ideas today for low maintenance. One side is fine. And again, you could structure these that your one side could be either way. And the other side, just one quick thing to do. So here's a combo. So if I set it up today, I'm using expiration of next week. What's next week? Next Friday is going to be June what? Next Friday will be June 7. So I'm going to set up a June 7 on the downside. I'm doing this both butterflies today. On the downside, I'm going to do a butterfly 70 points down from where we're at. We're at 52.20. So if I put the short 51.50 and I want to go 30 wide. So what's the first thing you do? We are currently at 52.20. The expected move to next Friday is 70 points. I'm going to set a butterfly 30 wide, 70 points down. Why 70? It's the expected move. Okay. Next. Do it to the upside. We're 52.20-ish. Go to 52.90 on the upside. $60 wide. Excuse me, 30 wide. What does that mean, 30 wide? What does that mean? It means the distance from the short call to the long call is 30. Distance from the short call to the other long call is 30. Now, the put side is 240. Now I can do the call side's 380. If I want to get them equal dollars, let's say I want to make this call side cheaper. Instead of 30 wide, I could make it 25 wide. I could do that. And that'll get them close. So this would be 240 for the call side, 260 for the put side. So to do this one time, it'd be about $500. That's your total risk. But what's great is, what is great is basically, well, you know what? Let me go back to the other way. Let me just tweak this a different way. Let me keep it at 30 wide. We'll just keep it 30 wide for each. And let me just make sure. June 7, that's right. I'm setting my short strike at 52.90, up 70. And the other strike, now that's the expected move, 70. But I'm going to come in. Let's come in just a tinge, and I'll show you why. Let's say I come in, bring everything in 10 points. So we'll go down 60 and up 60. Most of these are probably new to some of you. All right, that's better. But if you look at this, what's nice about this trade is it's positive theta. So time decay is working for you in a bit of a directional trade. And you can see that you're basically playing for direct, you've got a lot of room here. It's a directional trade with positive theta. So you could see if, let's just say let's run this on next Wednesday. That would be the 5th. You could see here, it's starting to rise a little bit. Let's go to next Thursday. Again, this could be different. But what we're trying to see is get it in one of these landing areas, right? On the downside, on the upside between 52.60 and let's say 5,300. On the downside between 51.80 and 51.30. This doesn't really become a problem till Friday, but this gives you a little more a way to play the direction. That would be called a directional or a multiple double butterfly. So before we ask you what you may like, oh, I shouldn't erase that. I'll put it up there, all the choices. How many can say, Dan, I've never done one of these? How many would say, Dan, out of these strategies, I haven't done any of them? So vertical A, B, skip strike butterfly, C, diagonal calendar, D, oh, we did 5 of these. Oh my goodness. D, 60-55, broken wing butterfly, and E, a double fly in the world. Now, you could say, what's the main reason the E double fly was low maintenance? Because for a short time, like a week, it can handle quite a move. So you're really on that one. I think I would just, if it moved towards the break even or something, you could just take it off because, I mean, you've got an awful lot of room. All right. So out of these, which appeals to you that you would be comfortable, you think if you were going to practice one for the next 10 weeks on paper or whatever, which one, if any, would appeal to you? A, B, C, D, E. And again, you could go. All right. Mark says the vertical. Anybody else? Andrew says C, the diagonal calendar. Lewis says C. Kumar A, the vertical. C and A, diagonal calendar and the vertical. Simon says C and D, diagonal calendar and that broken wing fly. Anybody else? Anybody else? How many of you say, Dan, I need an Excedrin aspirin after going through 5 strategies that most of them I've heard for the first time. I've made it through, but my head hurts. How many would say that? How many would say my head hurts, but I made it through? And we'll have to get t-shirts. I made it through 5 strategies. But anyways, one last thing. Oh, I forgot. One last thing, and I'll let you go. Let's see. Let me get this. If you go. Video, okay. Am I sharing my? Oh, there it is. I'm sorry. You can see the screen. How many can see this? You guys see this okay? Yeah, this is just where I'm at Sheridan Risk Management. And we've got each week now we have a session every day, Monday through Thursday at 9:50. We go for about an hour, look at the market, look at live trade ideas, have other students go over their trades, plan for the week, look at the upcoming news. And then at 2 p.m. each day, we do a class. And not next week, but the week after, we'll be starting some new classes. And I will be getting that information out to you. We also have special speakers. You got on-demand classes, a lot of stuff. If you're interested, all you do on the front page, you hit subscribe. And as you go down, you could look at that, and it gives you it's much cheaper than we used to do. You charge per class, which is still good value, but here for one price, you get everything per month. And I think that would be great. I think this would be a good time to get in just because the new classes will be starting. You can see the last week of the old classes we had, and those go at 2 p.m. And then the new classes would be starting not next week, the week after. And every 2 p.m. class, we usually do live trade. So if you're looking for something practical to kind of walk through and hold your hand through this, I think this would be a good help to you. Well, folks, have a wonderful weekend. If you have any questions, you can email me, Dan at SheridanRiskManagement.com, and we'll see you next time. Thanks.